Ladies and gentlemen, good day and welcome to the Max Healthcare's Q2 FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you.
Thank you. Good morning, everyone, and thank you for joining us on Max Healthcare's Q2 and H1 FY22 earnings conference call. We have with us Mr. Abhay Soi, Chairman and Managing Director, and Mr. Yogesh Sareen, Senior Director and Chief Financial Officer of the company. We'd like to begin the call with opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Abhay to make his opening remarks.
I wish you all a very good morning. It gives me great pleasure to welcome you to the second quarter earnings call for Max Healthcare for the financial year 2021 and 22. Let me start by giving you the key highlights of this quarter before opening it up for Q&A. In the second quarter FY22, the operation moved towards normalcy. The impact of various initiatives both on cost and revenue side got reflected in this quarter's results. And we also made considerable progress on the growth initiatives. There are 6 key highlights of the quarter's performance. 1. Significant drop in COVID admissions, leading to only 2% of occupied beds being used for COVID patients compared to 39% in the previous quarter. Second, normalization of OPD footfalls and return of surgeries to pre-COVID levels. In Q2 FY22, we had the highest ever OPD consults at 5.8 lakhs, which is a 49% sequential quarter-on-quarter increase. Almost all the surgical specialties, including those dependent on electives, saw a surge in admissions. Consequently, surgical medical mix improved to 53-47% from 35-65 in the previous quarter. The ARPOB improved and reached highest ever at 59,000, 14% higher than the previous quarter. This more than compensated for drop in occupancies from 81% in quarter 1 to 75% in quarter 2 of FY22. The vaccination and related revenues reduced from rupees 136 crores in the first quarter of the current year to rupees 91 crores in the second quarter. All these have culminated in achieving industry best EBITDA per bed of rupees 55 lakhs, a growth of 21% quarter on quarter and 112% year on year. ROCE for the quarter improved to 32%, excluding vaccinations and max lab related EBITDA. And we consequently generated 294 crores of cash from operations after payment of taxes, routine capex, finance cost, and movement in working capital. All mentioned has helped us report best ever performance in the second quarter FY22, despite revenue and margin from vaccination dropping significantly compared to previous quarter. In addition, the international patients footfall is still lagging at 1/3 of the pre-COVID levels, and the payer mix lever was avoided to retain high occupancy early in the quarter while COVID occupancy was reducing. This quarter can be characterized as almost entirely a non-COVID quarter, with improved footfalls, relatively higher surgical volumes leading to higher ARPOB. Most importantly, we continue to serve patients from economically weaker sections of the society, and in the second quarter FY22, we treated almost 35,000 patients in IPDs and OPDs free of charge. The value of treatment provided to such patients free of charge in the second quarter stood at 44 crores. We have 4 key highlights on the growth initiatives as well. We settled the ongoing dispute with the Vikrant Foundation and now have the right to aid development of a 500-bedded hospital on 3.5 acres of land falling between the two existing Max hospitals in South Delhi. This small value but big acquisition paves way for an integrated medical complex spread over 23 acres of land with a potential for 2,300 beds at a prime location in Delhi. Second, we have also been allotted 2 parcels of land in Gurgaon under an auction aggregating 11.4 acres, enabling addition of 1,000 beds in well-inhabited areas. Our present facility in Gurugram yields us the highest EBITDA per bed within our portfolio of hospitals. In addition, Government of Punjab has allotted us additional land contiguous to the existing hospital in Mohali. This will enable addition of another 190 beds. And finally, the construction work for Onco Tower for addition of 100 beds at Max Shalimar Bagh has commenced in September 21, and we expect these beds to become operational from the third quarter of FY24. Now coming to the overview of the financial performance for Q2 FY22, the gross revenue stood at 1,434 crores, a growth of 52% year-on-year. This includes rupees 91 crores from vaccinations compared to 136 crores in Q1 FY22. The gross revenue excluding vaccinations grew 42% year-on-year and 8% quarter-on-quarter. Non-institutional business share of revenue was 77% in the quarter. The contribution of digital channel improved to 11% of the overall revenue as compared to 8% in the previous quarter. We achieved the highest ever operating EBITDA of 362 crores in the second quarter FY22. Operating EBITDA excluding COVID vaccination and related antibody tests was 337 crores and reflects a growth of 12% quarter-on-quarter and 135% year-on-year. The profit after tax for this quarter was rupees 207 crores after exceptional cost of 8 crores for the ongoing VRS scheme at Nanavati Max. This is the fourth consecutive quarter where we have recorded the highest ever revenue, EBITDA and operating margin in our core operations. Max Laboratories, the non-captive pathology business vertical, non-COVID revenue grew by 67% year-on-year and 18% quarter-on-quarter. We are rapidly expanding our footprint in the lab business, and during the quarter alone, Max Lab has added 140 channel partners, taking the count of active partners to 600 now. Further, Max Lab is offering its services across 20 cities now. Max at Home also reported improved performance with gross revenue of 27.5 crores, representing a growth of 75% year-on-year. The 650 strong team of frontline and support staff served more than 60,000 patients during the quarter through home care, Max at Home. All of the mentioned has enabled the network to generate cash of rupees 294 crores during the quarter, of which rupees 93 crores was deployed towards growth initiatives mentioned. Consequently, net debt by end of quarter has been reduced to 259 crores. I would like to put the first half of FY22 performance in perspective. The operating EBITDA of rupees 722 crores for the first half of the current financial year has surpassed the full year EBITDA of any of the past years. Do note that our previous best full year EBITDA was 636 crores in FY21. Going into the future, whilst we believe the current state of operations is sustainable, we look forward to new levers of growth. While vaccination decline, we believe that our growth from Q3 onwards is likely to be fueled by the following. 1. Return of international business to pre-COVID levels and beyond. Second, improvement in payer mix towards non-institutional. Impact of senior clinicians onboarded in the second quarter of FY22, which was a significant number. Likely increase in insurance penetration, which is expected to increase by 10% as per CRISIL in the next 5 to 6 years. We are also planning to launch the proprietary app for digital by the end of this financial year. With this, we expect higher digital footfall as well as better experience for patients visiting the hospital. Consequently, we are confident of a strong, sustained performance in the future as well. On this note, now I wish to open it to Q&A. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then two. Participants are requested to use handsets while asking a question. Anyone who wishes to ask questions, please press star, then one. The first question is from the line of Damayanti Kerai from HSBC Securities. Please go ahead.
Hi, good morning. Thank you for the opportunity. Abhay, just wanted to understand how we should look at the ARPO number, which is one of the best in industry.
बोलत आहात त्याने तुमच्या कॉलला होल्डवर ठेवला आहे.
Hello, am I audible?
Yes.
Sorry, my question was on your, your ability to sustain growth for ARPO from current level, which is one of the highest in industry. So, where it can move from 59,000 in second quarter?
Well, we are expecting it to move up on account, like I mentioned, of onboarding senior clinicians, improvement in payer mix, because the previous quarter, beginning of the quarter was the switchover period when COVID occupancy, which was 81%, was dramatically coming down very quickly. So rather than hold back on institutional business, we encouraged it to have higher occupancy, no point keeping beds vacant. But now that it's gone up to about 75%, our overall occupancy, we are looking forward to reducing the institutional business going forward. I think the third is the preferred channels moving up in any case. And like I mentioned, the international business is yet to come back. So all of this should play out in higher ARPOB and higher EBITDA per bed as well.
Okay, so we should continue to see growth from current level on back of factors which you just mentioned.
That's right.
Yeah, and my second question is, can you update on uptake for the VRS scheme at Nanavati? Is it in line with your expectation, and how much of cost savings you expect by the end of this scheme?
So at present, it's slightly lower than our expectation. But having said that, we're expecting, we've extended the scheme. So typically it gets taken up towards the end on the last few days, and we are yet to sort of see that, and that we'll know closer to the finish date of the scheme.
Till when you have extended the scheme?
So I think the scheme should actually end in this week. We also taken action in terms of some other action, I would say, which will actually get us to the desired level of reduction in the manpower. So we actually kind of reducing the Badli workers, etc. They are in the hospital.
That's the contract workers.
Yeah. So I think basically where we, so it's, as Abhay mentioned, it's lower than what we expected. But I think with whatever action we're taking, we think we should be able to get to the levels that we wanted it to be, by the other method that we're using.
Okay, and my final question is on your capex plan for the current fiscal and next, I'll say, next 2 to 3 years in view of the land parcel which you have got and your expansion plans.
So essentially what we are looking to do is over the next 3 to 4 years, we're essentially looking to almost double capacity. And this is going to be at a cost of about 3,500 crores plus. We expect the first expansion plan, which is at Shalimar Bagh, to come through. We already started work over there in September 21, like I mentioned, and we expect commencement of operations by third quarter of FY24. So that will be the first. Subsequently, we are expecting the Mohali hospital, which is we are expanding by another 190 beds. We will expect to start work over here in the fourth quarter of FY22, and we're expecting again, completion of this in perhaps the third quarter of FY24. We are looking at starting the works at our Max Saket complex in the fourth quarter of FY22. The first phase should come up in 25. So, there's significant capacity expansion that we are looking at over the next 3 to 4 years. And this is going to be at a cost, like I mentioned, of over 3,500 crores, which we intend to sort of fund through our internal accruals itself.
Thanks, Abhay. I'll get back in the queue.
Thank you. The next question is from the line of Praveen Sahay from Edelweiss Financial. Please go ahead.
Yeah, hi. Thank you for taking my question, and first, congratulations on good set of numbers. So for this quarter, I can see that's a good improvement in the plants treatment and surgeries like ortho and general surgery has given. Can you give some color how much is of pent-up demand, or will we see in the coming quarters to continue in the similar numbers?
No, we believe this is sustainable numbers, and like I mentioned, international is yet to come back, which towards the end of the quarter has already started moving up, and we see this number grow in this current quarter and thereon. So we don't expect any. We believe this is sustainable. This is not any pent-up demand that was there.
Okay.
So yes,
okay.
it's immensely sustainable.
I think you would have also seen that we given the disclosure in the COVID slide that the occupancy in October was 81%.
Yeah, right.
So
Correct.
that shows you in terms of what this quarter is leading to.
So, secondly, related to this question, oncology has given around 230 plus crore of revenue. So, how much we can expect as a one specialization to go from here? Whether we have a capacity in a place to go further, significant upside in the contribution from such kind of treatments.
So oncology stands at about 13% of our total overall sales. So
yeah, and it's the largest growing specialty.
It's the largest growing specialty, but at the same time, it's only 13-14% of our overall revenue. So it's not as if there is over dependence on one. That's probably the largest in our portfolio as specialties, but nevertheless, it's only about 13-14% of the overall revenue.
Right. Okay. Lastly, sir, on the clarification, one is related to the institution business. In this quarter, we had seen contribution has increased. So, what the reason for that?
It is like I mentioned previously. This was also a switchover quarter, or the beginning of the quarter was a switchover period. Our occupancy under COVID was beyond 81%. And that COVID occupancy came down, and there is typically a couple of weeks of lag between non-COVID business coming back and COVID going down. So when you have this sort of switchover, rather than keeping beds empty, we did institutional business over there because at least it is contribution positive, although it's a bit a negative business. But towards the end of the quarter, now that you see this high sort of occupancy of non-COVID and preferred channels, etc., you will see this changeover. Again, you'll see institutional business reducing in quarters to come, in line with what we sought.
Yeah. Okay. Great. Thank you, sir. Thank you for taking my questions. All the best.
Thank you.
Thank you. The next question is from the line of Abhishek Sharma from Jefferies. Please go ahead.
Yeah. Hi. Good morning. Thanks for taking my questions. Just two. I was looking for two comments. First on Saket as one single facility of 2,300 beds. So how do we determine that you can absorb 2,300 beds in one location? Right now you're operating 770 beds. So what gives us confidence that we can scale up to 2,300 beds in that location? And then similarly on Gurgaon, considering the fact that it's a more competitive kind of a market, how are you looking at adding 1,000 beds there, and how will you position yourself in that market? Thanks.
Right. So I think first and foremost, what we are seeing is at Max Saket, which is a hub, we've got 750 beds or 770 beds over there right now. With the land banks and the land that we've been able to tie up, okay, we potentially can go up to 2,300 beds. Okay, we're not going necessarily up to the 2,300 beds in, that's the potential of the place. What we're looking to do, I mean, we're operating in extremely high capacity over there and with even very low institutional business. So the first phase you'll see is about 350 beds, which should come up by, in FY25. And this is on 770 beds. And like I said, we're already tearing at the seams today for these 770 beds. In 2 to 3 years down the line, I see when this capacity of 350 in FY25 come up additional, it taken up extremely quickly, because you're going to see very fast occupancy of these 350 beds. The second phase is going to be another 250 beds in Max Saket, okay, which is going to come up in FY27. So we are looking at expanding it by 600 beds, but this is entirely going to happen up till FY27 rather than before that. So I think we are fairly comfortable between what we can do in Max Saket. Thereafter, any expansion is going to be based on what has been taken up in the first phase and the second phase of expansion. Any subsequent expansion is going to be thereafter. As far as Gurgaon is concerned, it is a competitive market, but it's also extremely lucrative market. So our highest RPOB in our portfolio, our highest EBITDA per bed in our portfolio is in our hospital in Gurgaon. We see similar sort of numbers as far as our competitors are there as well. So we are quite confident about Gurgaon. What gives us the advantage is that we can have these 1,000 beds in 2 separate facilities. One right in the middle of Golf Course Road, which from a location standpoint we believe is better than any of the peers, any of the competitors, because this is as prime as you can get. And the other piece of land is about 550 meters away from Golf Course Road. Again, we're looking at setting this up sequentially. By FY26, you should have about 500 beds ready. The first phase will be, we are looking at starting works over there by Q3, Q4, FY23. And, the balance 500 beds will be post FY28. So we're quite comfortable in terms of our ability to absorb, because we believe there is a huge amount of latent business today in both these locations that we have.
Thanks for...
To add that, if you look at the DHRP that, Medanta has filed, there's a CRISIL report there, and it says that the NCR penetration is only 1.9 beds per 1,000, right? Which is lower than Indore, lower than Patna. So I'm saying, so while you see that there are a lot of beds, but see the penetration also. It's a very populous, market that we have. It's basically 80% of youth, right, living in NCR.
Yeah. Thanks, Abhay. Thanks, Yogesh, for that clarity and the fact that you're bringing bed capacity gradually. I just had one more question. When I compare your non-institutional ARPOB, it's way higher as compared to your peers, right? I mean, now, while you already have the best ARPOB, it's somewhat suppressed because of your institutional business. So when I adjust it for the non-institutional piece, it's way higher. So what has led to this kind of gap between, your ARPOBs versus your competitors?
I think first and foremost is the location that we are located in metros. And usually, typically you have a lot of preponderance of specialists and super specialists. While there is a paucity in most of the country, the super specialists and specialists do reside in the metro cities. So our hospitals are given to higher end surgeries, more tertiary care, more quaternary care relative to anybody else. We have 85% of our capacity which is metro-centric, and most of the expansions that you're seeing is also in the metros. This should take up our metro-based capacity. Not only are we doubling our capacity over the next 4 odd years, but we are also we are going to turn out that 95% plus of our capacity, resultant capacity thereafter, is going to be metro-centric. Now, what happens is most people, whether domestically or internationally, whilst they get the lower end surgeries and procedures done in their in their local sort of markets and areas, they travel to large metros in India for higher tertiary care. So that sort of leads to and we another indicator is that we have a significantly higher amount of beds which are critical care beds. 30% of our total beds is critical care capacity, which is ICU beds, which is again a number which is higher than most of our peers. So I think this, it's a virtuous circle you are in. We are located in the cities where the specialists reside. Our infrastructure is geared to tertiary care and quaternary care. That's what we do, and that's what sort of leads to higher ARPOBs and EBITDA per bed. I mean, if you actually see the three indicators for ARPOB, one is pricing. We are certainly not the highest. If you look at the payer mix, clearly, like you mentioned, it's the inferior payer mix compared to some of our competitors as well. But as far as the third is concerned, which is the surgical mix, we have such a superior surgical mix that it sort of doesn't compensate, but even overcompensates for the lack of the first two. And that's really the resilience and the moat around our business.
So if I understand, so like for like any other premium hospital chain which is out there, let's say Medanta in Gurgaon or Fortis FMRI in Gurgaon, will they have similar ARPOBs as your Saket hospital, let's say, for example, or will there still be a difference because of the surgical mix?
Yeah, I think we expect there will be a difference because of the surgical mix. Because, for example, in Saket we do liver transplants, right? So a fair proportion of the revenues come from LTPs and KTPs, etc. that we do, and they are it's a 21-day stay and it's a 21 lakh package, so it's a 100,000 rupees ARPOB for the patient, right? So obviously there are those programs which actually lends it to higher ARPOB, and there would be some difference vis-a-vis the other players because of this. And also, I think the other fact is that we have larger share of oncology vis-a-vis other competitors, right? So we see our share of oncology vis-a-vis, let's say Fortis or Apollo or even Medanta, we have a larger share, and that itself also lends it to higher ARPOB because there's a data business which comes with it, right? This chemotherapy, etc. So relatively speaking, oncology has higher ARPOB.
And proportionally, we do a lot more liver transplants, kidney transplants, lung, heart transplants, etc. Compared to this, more, we are more on the higher end of the quaternary care and tertiary care than relative to some of the other players.
Perfect. Thanks, Abhay, and thanks, Yogesh. Yeah, I'll get back to you.
Thank you. The next question is from the line of Sonal Gupta from L&T Mutual Fund. Please go ahead.
Yeah, hi, good morning, and thanks for taking my question. Abhay, in your one of the drivers that you mentioned for Q3 onwards growth was the impact of senior clinicians you onboarded. So I'm just wondering, I mean, like given that we are already operating at like 75% and like you mentioned, October is 81% occupancy. How does this, how will this improve further? Or you
I think the way to look at it is, and I keep saying that the way to look at it is we can look at it as glass half full or half empty. The fact is that although it's 80% occupancy, but 1/3 of the beds are today catering to institutional business. Rather we do this business is contribution positive but EBITDA negative. So rather than keeping beds idle, we continue doing this business. As you see, the preferred channels grow and grow on account of onboarding senior clinicians, grow on account of higher proliferation of insurance, and we've seen this segment grow significantly, grow on account of international business coming back entirely. This will displace the institutional business, which is because we have no choice. It will displace the institutional business. This institutional business is at a 40% discount, to my normal preferred channel. So what happens is, the minute I displace it, I'm able to derive 40% better pricing, 85% of which comes straight to my EBITDA. So this is a significant lever that you're going to see over the next couple of years, prior to our new capacities coming out, because like you rightly alluded, we already at a high capacity. Where do you go from here before your new capacity sort of comes in 2 or 3 years later? So in the interim, we can look at it as 80% occupancy, or we can look at it as occupancy of 50% with preferred business and the balance with unpreferred sort of business.
Got it. And in terms of the costs, then with the clinicians, you expect that that cost will sort of remain in the range that it has been or?
Absolutely. So look, our cost in terms of percentage in best in class. At the same time, our clinicians are able to earn more or generate more for themselves, compared to anybody else out there. And it's a simple function of our ability to generate more through higher end surgical programs. So if you actually see, and you've seen, our ARPOBs, our average revenue per bed is significantly higher than anybody else. So that essentially, again, you get into this virtuous cycle where as a percentage, the total payout for us is the best in class, yet the doctor is able to generate more.
Got it. And just my last question on what has been the cost of acquiring this land in Gurgaon? I mean, like, what is the payment for this?
So it will be a total of 300 crores, including the TDR that we're going to buy it for. For the additional TDR, 0.5% FSI will be bought from the market. The total loss will be around 300 crores. We already paid 28 crores in quarter 2, and balance it to be paid by March.
That works out to, let's say, 30 lakhs a bed. Cost of constructing a bed is 1.2 crores, so that's about 1.5 crores a bed. Our EBITDA per bed right now in Gurgaon is, I think, 66 lakhs or 70 lakhs rupees. So you can imagine the sort of ROCE that we are looking at over there. I mean, the network EBITDA per bed is 55 lakhs. In Gurgaon itself, we are doing about 66, 68 lakhs.
Got it. So this is the total payment that you have to make by March, and then you will have control of the land, right?
Yes,
that's right.
And so on an aggregate overall basis, what is the total capex or spend that you're expecting this year and next year?
So in the current year, FY22, we are expecting capex on brownfields of about 198 crores.
Yeah.
FY23, we are looking at 486 crores. FY24, we are looking at 514 crores. And FY25, we are looking at 587 crores on brownfields. On the greenfields, we are looking at 160 crores, in FY23, 155 crores in FY24, and 190 crores in FY25. So in summation, FY22 remains 198, or let's say 200 crores. FY23 will be 600 crores. FY24 would be 750 crores.
Got it. And the land payments are separate, right?
No. This is all in.
All in.
Sorry, land is separate. Land is separate.
We already paid some money in this quarter.
Right.
There's some balance payment we made. So
what is the balance?
So balance is to be around 190 crores to be paid.
About 190 crores to be paid.
Right. Got it. No, so total capex for this year, including these payments for FY22, is how much?
So I think we mentioned this already. So what we spending on the so the project CapEx is less than 200 crores plus 180 of the I would say the land that we have to be paid. Total 380. Right. This does not include routine CapEx. Routine CapEx is roughly around 160 crores. All right.
Okay.
So it's a 280 plus 160. It's 440 kind of a number that we will have for the CapEx, including projects in this year.
I mean, at current run rate, our free cash flows are over 1,000 crores after routine capex. So that's sort of.
Yeah.
Sure. Got it. Sure. Thanks a lot for taking the question.
So we are only looking to deploy a part of our internal accruals, over the next 3 to 4 years, and this would absorb our entire project costs.
Got it. Great. Thank you so much.
Thank you. The next question is from the line of Nikhil Mathur from HDFC Mutual Fund. Please go ahead.
Yeah, hi, good morning, and thanks for taking my question. So I had a question on the expansion plans, whether it's Shalimar or in Saket and also in Gurugram. I want to understand the target population that Max is trying to cater to. Is it more of domestic medical tourism from other parts of the country? Is it more international? Or within Delhi NCR itself, you're seeing some bit of increased demand or some bit of lack of facilities for which you are going so aggressive again on the Delhi NCR region itself. So what is the target population here that the company is trying to target?
Look, I think at the macro level, all of the above. Okay, so we're not looking at doing it in, only for international, only for, Delhi NCR or people from outside Delhi NCR. We are focusing on high-end tertiary care programs. We believe hospitals such as ours are not only an answer to India's healthcare problems, but world's healthcare problems, okay, simply because of, the sort of skill sets that we have, the cost we are able to do it at, the technology, equipment and infrastructure that we can create. So I think all of it sort of lends to that. This is at the top level, this is at the top down. So once you're able to create these programs, able to expand these programs like we've been able to do effectively and attract clinicians to be able to participate in these programs, then those programs lend themselves to all of these. Because you're likely to do a delivery in a small town around Delhi, which people perhaps, or angioplasty, for which people used to come to Delhi earlier, they don't anymore. But for a kidney transplant, you will travel to the best clinician possible, and so on. And we believe this market, not only in Delhi NCR, but domestically, in other parts of the country, increasing as well. Now, having said all of that, we also looking at a bottom-up approach. Each one of these facilities where we are looking to expand, okay, is operating at 80% plus capacity, with lower institutional business, and over the next 2 to 3 years, we believe that these facilities will be bursting at the seams, and these are brownfields largely. So essentially what we are saying is that, look, there is no way out. We have to be able to procure land which is contiguous, and we need to expand capacity over there. So each facility has its own justification. Just to give you a case in point, we have ability to expand further at BLK by another 200 beds. This is at BLK Max in Karol Bagh, but we're not doing so. Shalimar Bagh, we've had the land and the plans to expand over the last 4 years, but it's been done now. It's a little late in the day because we had COVID last year. We couldn't. But, each one of these is being timed in a manner that will absorb what we are seeing as increase in capacity in the short to medium term. So each capacity that you see will come out is going to come out post demand. So we're not creating capacity and saying, look, hey, where's the demand going to come from? We believe the demand is already there. And the capacity is going to be, 6 months, 1 year, 1.5 years later that is going to flow in.
Okay, so in some sense you are suggesting that the demand is there and the requisite capacity or the infrastructure is missing. So that requisite infra to boost that, what is the key priority? Is it onboarding of clinicians or getting the right location? So why has that gap created, and which you are looking to target, and which other competitors might not be able to target so easily like you are able to?
I'm sorry, I didn't understand the question. Can you just repeat it?
So the question really is that why has what has created this demand-supply gap? So you are suggesting that a demand is already there. There is a gap on offerings, whether it is requisite hospitals or clinicians. So how come Max will be able to capture this gap while other competitors might not be able to capture this gap?
Because we have the land. I think the biggest differentiator is land. So, case in point, Mumbai, for example, okay, you've seen most hospitals have, hit capacity sort of ceilings many years ago, perhaps even decades ago. So it's not as if you can expand the Hinduja hospital because that's the only land that they have. Or you can't do it at Leelavati Hospital or Jaslok or Breach Candy and so on and so forth. Okay. Whilst you have Nanavati Hospital where you have the extra land, we are building that out. It's availability of land in the heart of the city. Similarly in Delhi, we have this land available which is not available to anybody else. To have land in the middle of South Delhi, the kind of land banks that we have is everybody would love to. I'd love to have the similar land bank in Chennai, and I'm sure Apollo would like to have the similar land bank in Delhi, and Manipal I would like to have in Bangalore and vice versa, but it's not available to each. Whoever has whatever is sort of building out on that. I think the biggest problem is being able to acquire land in these metros, and these are large parcels of land which are required, which are well located, well connected and so on, which is the big differentiator.
Sure, thanks. Another quick question I had was, is there any revenue contribution which is meaningful from the COVID protocols that are being followed for inpatients? whether it is PPE or biofire test or other COVID test that are part of the revenue and might taper off fairly sharply in the coming quarters?
None. So like
other than vaccination, there's hardly any revenue. We said that already. It's less than 2% in this quarter.
Yes.
Okay, so no meaningful contribution is being in the inpatient revenues that has been booked in third quarter.
Nothing.
Okay.
We believe these current numbers are highly sustainable and they're levers to grow it, like I said in my conversation.
No, absolutely. I mean, yeah.
We had in this quarter, they were all more of them in ICU and on ventilators, and to that extent, the ARPA of the COVID patient is same as the others in this quarter.
Okay, sure.
Less than 2% of occupied beds, or maybe 1.5% of our total beds which are occupied by COVID. So, just to confirm the point, there are no other attendant or separate revenue streams which are COVID related.
Okay. And then on ARPOB, again, the comments are suggesting that going forward as the mix improves, as some of the international patients come back, this ARPOB is going to improve. Are you also witnessing slightly inflationary trends on your various costs and you might want to pass that on, and so ARPOB can have an element of slightly improvement or higher improvement on the back of the recent inflationary trends as well?
So not in quarter two, but we do think that the drug prices may go up a bit, in future, as we've seen some shortages out there, and to that extent it will get passed on. But not that we haven't seen much of that in quarter two as yet.
But there's also been some news articles about NPPA prices being revised by 20%. And these are drug manufacturers which have been pushing the government to increase it by 20%. So if that happens, that should augur well for us. In fact, the margins, there should be a little more contribution there.
Okay, great. Thanks a lot.
Thank you. The next question is from the line of Suchi Srivastava from Edelweiss. Please go ahead.
Hi, sir. Congratulations on great set of numbers. I'm not sure. I joined this a little late, so wanted to confirm if somebody else has asked this question. But this was more on direction of the promoter entity Kayak Investment. How are they trying to take their stake? It's already come down to 37% from here on. How do you think the arrangement is going to be like?
So I do not. I mean, as a company, we do not hold a brief, and I can't comment on Kayak's shareholding with their investors. You will have to ask. There are no strings. There are no. You'll have to essentially direct this question to Kayak, I think.
Yeah, we are not about to answer it.
Understood. No worries. Thank you.
Yeah, all right.
Thank you. The next question is from the line of Bharat Sheth from Quest Investments. Please go ahead.
Hi, thanks for the opportunity. Sir, one question is on the update on the expansion at Nanavati. When do we see and when is likely to be operational?
So we are looking at the first phase, which is going to be 330 beds. Okay, should be operational by early FY25.
Okay.
Works over there have sort of started, so we should be. That's the first phase. The second phase will be operational by early FY27.
Okay. Sir, would you like to comment something on the diagnostic business? How would you like to take it forward, and ultimately setting up a separate business unit only? So in subsidiary or?
So it is a separate business unit. We are investing extensively in this. We had 450 or 460 channel partners. We've added another 140 in the last quarter alone. So that's almost a 25% increase in number of partners in one quarter. So you can, this is indicative of how we are looking at this business, how we are sort of doubling down on this business. We've seen the numbers, the non-COVID revenue on this grow extensively as well. And as soon as we have a little bit of critical mass, we will move it down into a separate vehicle. Right now, we don't want to sort of when that critical mass can come through both organic as well as inorganic manner. And we have been in conversations and we continue to be in conversations to look at opportunities for acquisition as well. And once we're able to do it, we'll split it into a separate, be it a subsidiary or a demerged entity, is something to be seen.
Okay. So you just mentioned that we want to doubling down. So any time frame in doubling down this business?
No, I mean, that's more a statement of intent when I said doubling down. I mean, doubling down in the sense that we're investing to create more and more franchisees. We have, whilst we are looking at inorganic acquisitions, we have, great ambitions to grow it, organically as well, and this is what we are doing.
Okay.
If you compare the business in quarter 1 of FY21 to quarter 1 of this year, I mean, solid double down, right? So you can have take quarter 2 of last year to this quarter, it's 14 crores to 22 crores. So it's actually growing in that manner, right? So what Abhay is saying that we will continue to grow here on, and our endeavor is that it should become a sizable business. And we have said that we want to be, in the top 5 in this business.
Okay. Sir, last question. When other people, as you rightly said, is facing a land acquisition in the city problem, whereas we are currently placed much better. So which are other challenge that do you see, I mean, onboarding of senior clinician and how this really works?
Sorry?
So other players where we are seeing, I mean, land availability as a challenge where we are better placed on. But which are other major challenges that we envisage to grow the business?
So I think, we are looking at, whilst our expansions are going to come in line in the next 2 to 3 years, and capacity expansion is going to be happening thereafter. In the interim, we are going to be looking at using the payer mix lever, to increase both ARPOBs as well as EBITDA per bed and profitability. We are also generating significant amount of free cash flows in excess of what we can deploy in in doubling our capacity over the next 4 to 5 years through organic, both greenfield as well as brownfield. So I think the challenges that we are facing right now, well, not challenges, they're good challenges to face. We are looking at acquisition opportunities, which we are evaluating, and the challenges will be entering new markets and acquiring new facilities, and do value unlocking in similar manners that we've done in the past. So I think we are looking at growth-related challenges, which we are sort of engaged in evaluating at present, and which should give us an upside in terms of both revenues as well as profitability in the short to medium run.
Okay. And sir, I mean, when you are talking of new geography, so which are the new geography that we are evaluating in first and second line?
I think we are looking at other metros. We are looking at Maharashtra. We're looking at some south-based listing as well. But we're also looking at acquisition opportunities in geographies that we are already existent in the north to add to our our hospitals. Like I said, already operating at very high capacity. Places like even the tier 2 cities we operate in, they are perhaps the highest ROCE businesses that we are doing right now. We don't intend to build out over there. We intend to acquire or get into collaboration with developers who will be doing build to suit for us. That sort of defrays the construction and the build out risk from our books, both the risk of time and cost overruns. So we're quite excited about that as well.
Okay, thank you very much, sir. All the best.
Thank you.
The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, good morning, sir, and congrats for a good set of numbers. Just one clarification on this capex thing. So this 3,500 capex that you alluded to, it includes land but excludes the maintenance capex, or that also includes the maintenance capex also?
Actually, the other way around. It excludes land. It excludes lands, and excludes maintenance capex. This is other than maintenance capex. Our maintenance capex is about 130 crores per year.
Okay. So, and you mentioned this has to be spent in the next 4 to 5 years, the 3,500 crores, right, sir?
That's right.
Yeah.
So what would be the capex, including both maintenance and land for this expansion? Means for this expansion that we are talking of almost doubling the capacity next 4 to 5 years.
If you take, let's say, I mean, you'll have to take a particular run rate, right? So if you take today's run rate, H1, we had 720 crores or 722 crores of EBITDA. You sort of double it to about 1450 crores. So you have, I think by next quarter we should effectively be net debt free. So I won't really take an interest cost. You reduce about 130 crores of maintenance capex and then tax of another 100 crores of tax. So that's 240 from 1450. You get to about 1200 crores. Maybe some change in working capital of 40-50 crores. So you're looking at about 11 to 1200 crores of free cash flows effectively, and per year. So your free cash flows itself should be northwards of 5,000-6,000 crores over the next 4 to 5 years, and your total capex towards other than the maintenance capex, which has already been covered in this calculation, okay, which is 3,500 crores, okay, should be taken care of through internal accruals. Now, do keep in mind that the first 2 years, you're going to be spending less than, the majority of the expenditures towards the back end of the project period, because that's when you do the fit outs and the more expensive equipment and so on and so forth. Whilst the first part is really the superstructure, etc., which has to be created, which is less expensive. So we are sort of quite confident that this will more than be absorbed by our internal accruals itself.
Sure. But sir, you also included. Sorry.
So your question was on routine capex. I think routine capex spent from FY22 to FY26 will be in the vicinity of 800 crores.
Okay, so 3,500 plus 800 plus land extra. That's the way to look at this entire capex, right, sir?
So 3,000 plus 800, 3,800 is what you should take from FY22 to FY26.
But this 3,800 excludes land. That's my main question, sir. Or it includes land.
Yes, that includes land rest.
That's 300 crores.
Yeah, that's 300 crores.
Okay. And sir, the second question is, you also mentioned that you are also looking at acquisition both in terms of your new age businesses as hospitals. So you think that would also suffice from the internal accruals, or at that point of time there will have to look at raising equity, or also maybe to look at some debt?
No, look, like I said, this is a debt-free balance sheet by next quarter. Even if you were to look at a prudent debt to EBITDA of 2 to 2.5 times, okay, that will, over the next 3 to 4 years, that should give you another 5,000-6,000 crores of war chest. Other than that, from your 5,000-6,000 crores internal accruals, you're deploying maybe 4,000 crores or 3.5 to 4,000 crores as far as internal accruals post, and 5,000 to 6,000 crores is internal accruals, free cash flows, post maintenance capex of 800 that has been mentioned by Yogesh. So you're going to look at 3,500 of that you will deploy towards projects, but the balance is there, plus your ability to leverage the balance sheet. So I don't see any case for raising equity, but certainly we will use our balance sheet for these acquisitions as well.
Sure, sir. And just one on this mix, you had in the previous calls mentioned that this 35% institution and 5% international. So you would like to bring down the institution from 35 to like 15-20% next 2-3 years, and the international to about double digits. So you continue to look at that way. And secondly, you're also adding capacity. So is it that this mix will first go down, and as we add capacity, again the mix of institution will go up, or structurally the way things are moving, once it goes to this 15-20, it will more or less remain in this range?
I think first and foremost, the international was about 11% prior to COVID. So that we are just looking at it bouncing back to pre-COVID levels and then go beyond. So the 11% or double digits is not so much of a challenge. I think as far as the changeover from this 35 to 15 that you rightly mentioned, again, at high capacity we have no choice, and it's this is something we intended to do. As our preferred channel grows by by a certain percentage, it has no choice but to displace the unpreferred channel, which will happen in line with what we had discussed. There was a little bit of disruption in being able to do so because we had to be tactical, during this COVID switchovers and so on and so forth, which has happened over the last year and a half. Hopefully, if there isn't a third wave and business is sort of secularly going up as going on as normal, okay, we should be in line or even perhaps faster than what we had guided earlier towards. The capacities we are looking at is sequentially, which is going to come up in 3 to 4 years later. We don't believe will be catering to institutional business because it's coming out in phases, and these are very small capacities considering the pre-existing capacities over there. We believe this will be taken up by the latent demand of preferred channel business rather than institutional.
Thank you very much, sir.
Thank you. The next question is from the line of Charulata Gaidhani from Dalal & Broacha. Please go ahead.
Yeah, congrats on the good set of numbers. I have 3 questions. One, in terms of international patients, what is the visibility that you have? From when do you see growth in international patients coming in? Are there any issues relating to visas?
So I think if you actually see, during the quarter, it was 33% of pre-COVID levels. At the end of the quarter, it's already come to 50% of pre-COVID levels. With opening up of flights and, even the government of India is giving huge amounts of visas, including medical visas, free to encourage tourism to India and opening up of flights, we believe this number of 50% of pre-COVID levels again should ramp up very quickly by the end of the financial year to perhaps pre-COVID levels. So we're quite confident of course, this is all, from today's vantage point and hoping no third wave comes to that extent either here or in the countries where international tourists come from. So yes, we're quite encouraged by the numbers right now, and we believe this trajectory should lead to a return of medical tourism hopefully by the end of the financial year.
Okay. And normally in terms of the operations, you have the confirmations from patients. What is the time frame that you operate on?
Sorry, I didn't understand the question.
In the sense when there are international patients coming into the Max network, you all would be knowing possibly a month in advance that these patients and surgeries are lined up for the foreign patients?
That's right. So, that pipeline continues. A lot of people are waiting on this thing, waiting for connectivity and for flights to open up. Typically, the pipeline is there, but people are unable to act upon it simply because there is no way of making the way into the country.
Right. Okay. My second question pertains to the EBITDA per bed of 30 lakhs. That is at what occupancy level?
Our EBITDA per bed is 55 lakhs. And it is at an occupancy level of 75%. And end of the quarter, it was 81%.
Okay. 55 at around 75% occupancy. Right. And the last question pertains to the brownfield expansions. What is the time frame for completing the brownfield expansions? Is it like as good as a greenfield or it is faster than greenfield?
A, it is faster. B, it is more lucrative. And C, the investment for a brownfield is less. So all of these 3 things apply. They are going to be opening up in different times. I think the first one would be Shalimar Bagh, which is September to December 2023. But everything else will be in quick successions thereafter within the next 18 months from that date.
Okay. Okay, fine. All the best. Thank you.
Thank you. Thank you so much.
Thank you. The next question is from the line of Prakash from Axis Capital. Please go ahead.
Yeah, hi. Am I audible?
Yes, Prakash.
Yeah, good morning and congrats on the numbers. Just one question of clarification rather. So we have seen significant improvement in ARPOBs, and you have already alluded to what are the further scope in terms of payer mix and case mix. But looking at Q1 to Q2 jump, should we see it as an average of the two in terms of ARPOB going forward, or you think this is the base? I ask this because I understand for many other companies that there is a lot of pent up with opening of travel, etc. has happened. So just trying to understand going forward, what would be the average ARPOB levels from here on?
So I don't actually see, assuming there is no COVID third wave which sort of affects ARPOB, I don't see the ARPOBs going down. I see them going up. I don't see COVID for us was, we generated lower ARPOBs during COVID. Even if you look at pre-COVID times, okay, we were doing about 56,000 of ARPOB, which number, kind of got dislocated last year due to COVID, and that 56,000 now on a non-COVID quarter, you're seeing as 59,000. So that's one. Second is, as far as the international is concerned, we don't see any pent-up coming because, like I said, it's only in this quarter, only 1/3 of international came back. I mean, if there's pent-up, then we should have been doing 110, 120%. More than pre-COVID levels. That number towards the end of the quarter has come up to about 50%, and we are hoping that it comes back to 100% and beyond by the end of the financial year. So we are not seeing any sort of bounce up of pent-up demand. I mean, the highest demand, highest occupancy that we've seen within the quarter, okay, has been at the end of October, rather than beginning. Typically, a pent-up would happen, in the beginning of the quarter, not with a 3-month lag. Post-COVID coming down.
Okay, by pent-up I meant interstate, intercity, etc. I mean, I didn't mean international.
No, I am not seeing any such this thing. I think is fairly secular, and it continues. Yes, you'll always have demand come down by a few days during Diwali, but it's back to sort of normal this thing. We are not seeing really pent-up demand from that standpoint. Pre-COVID levels, we were at 56,000 ARPOB, and our occupancy was 73-74%. You're seeing 75% and 59,000. So, I mean, it's not such a, sequentially quarter on quarter you're seeing a jump, but if I compare it to FY20, you don't see a jump.
Understood. Fair enough.
And for FY21, ARPOB was 56,900, right? So this is in the public domain. So that way, it's not a big increase from those numbers.
Perfect. And you said that the exit rate, I mean, current occupancy rates are around 80% plus?
81%, yeah, in the October. So we are not disclosing the current, capacity, but we're saying what was the number in October.
Okay,
end of October.
So just trying to, connect the dots. So when I had last quarter, 81% and 55,000 ARPOB, we were at 25% margin. Q2, we had 59 and 75% occupancy. So if we are at 80% plus occupancy plus 59 to 60,000 kind of ARPOB, so we are heading for some more margin improvement. Would that be fair to understand?
No, well, I would expect margin improvements, but perhaps not on discount because it's also although there was no COVID, there was higher towards the end of October. You had dengue. Which again, those beds come at a cost of the surgical beds at that point of time, but it's not a big give or take. So effectively, I think 75-77% sort of occupancy levels is what needs to be looked at, and ARPOBs, which are the base will be this, and with international travel and payer mix levers, we see that improving. And typically also you'll see H2 is better than H1, right?
Yeah. And lastly, on the occupancy side, at what occupancy levels you are really comfortable? I mean, where there is no hiccups in operations?
77-78% at best on a sustainable basis. But like I said, the big lever over here is now displacing the institutional.
Okay. And you are currently operating at 81%.
Well, dengue months we typically operate at high, so it is 81%, but it's not a sustainable 81. You don't operate at 81% through the year.
Okay. So base business 75 to 80% and something else.
77, 78%. Yeah, 77, 78% max on the base levels.
Okay.
On a sustainable basis.
Got it, sir. Thank you so much. All the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
So I wish you all a very happy Diwali, and hopefully we need to keep ourselves safe and sorted, because and hopefully avoid any third wave. Thank you so much for making the time and being on this call.
Thank you very much, sir. Ladies and gentlemen, on behalf of Max Healthcare, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.